Welcome everyone to our Wednesday at 1 p.m. workshop. Thank you all for joining us. We're going to give it just a few seconds here, let people go ahead and jump on, and then we will get started. Hope everyone had a great week so far. We're halfway through. All right, so today is the downside protection in uncertain times. As you know, the market is a little different than it has been in the past. There was a huge seller's market and now interest rates are rising, but we have a great guest speaker for you today. Before we get started, just a few things. NuView is not a financial advisor. We are a self-directed IRA custodian for alternative investments. We do not give legal or tax advice. We are very knowledgeable when it comes to IRAs, education savings accounts, and health savings accounts, as well as solo 401ks. So we can definitely answer questions when it comes to the plans and how they work. Now, what is a self-directed IRA? It gives you the ability to make choices into alternative type of investments like real estate, mortgage notes, tax liens, things that you might already be doing with your own cash. Now, why would you want to self-direct your IRA? Well, it comes with diversification in your portfolio. That's number one. So you might have all your money in the stock market right now, but do you want to have all your money and all your eggs in one basket, or do you want to diversify? Chances are you might want to diversify a portfolio, better chances of succeeding and building your wealth that way. Not only that, you get tax savings. So depending on the type of IRA you're using, it might grow tax-free or tax deferred. And not only that, you're investing in what you know best. You're investing in things that are tangible assets like real estate. It's brick, it's mortar, you can see it, you understand that market. It's a lot easier to understand than the stock market, which is very unpredictable. In the past couple of months, we've seen a huge downturn. My phones have been blowing up. Lots of people very worried about their IRAs or their 401ks and wondering what they can do to get out of the stock market and invest in these other types of assets. So these are the types of plans that you can self-direct. If you're new, these are probably new to you. If you have never been to one of our workshops before, I'm going to go and review these. If you're a current client, you've probably seen this before, but you got your traditional IRAs and your Roth IRAs. They're the most common type of IRAs. The traditional IRA is usually the most common because most people that have left employers have done a direct rollover from that employer plan, 401k, 403b, TSP, and it's usually pre-tax dollars. And that can be moved over to a traditional IRA. If you're just starting a traditional IRA, the contribution limit is $6,000 a year. If you're over the age of 50, you have an additional $1,000 catch-up contribution. And then you have your Roth IRA. Most people do like this plan because it's taxed a little bit differently. The way that Roth works is you pay the taxes once you make those contributions. So that $6,000 contribution you make to it, you're going to pay the taxes on it now. But then going forward, as you invest and that Roth IRA starts to grow for you, it's tax exempt. And when you're ready to take the money out of the Roth, it's tax free. If you're over the age of 50, there's an additional $1,000 catch-up contribution. Now, if you have that traditional IRA and you'd rather invest with a Roth, what you could do is called a Roth conversion. You can convert those pre-tax dollars into post-tax dollars. And that's really up to you because whatever you do convert is going to be added to your taxable income. So it potentially can increase your tax bracket. That's something you want to discuss with your CPA or financial advisor before doing it. What I've seen clients do is they just convert a little bit at a time until they've converted their pre-tax dollars to post-tax dollars. And then guess what? The rest of their life, their investments will be growing tax exempt in that Roth IRA and taken out tax-free when they're ready. And your beneficiaries also inherit it tax-free. So the employer plans, you have your solo 401k, your SEP IRA, and your simple IRA. They have higher contribution limits than personal plans. Now, in order to be eligible for a solo 401k, you must be self-employed with no common law employees. You can contribute up to $61,000 a year. That's a big difference between a traditional and Roth IRA. And then you can also do a catch-up contribution if you're over the age of 50 of an additional $6,500. So that's a great way for anyone listening that is self-employed to jumpstart that IRA and start investing into alternative assets. A lot of these alternative assets might have like a minimum buy-in of, $50,000 or something. Well, this gives you an opportunity to do that. Your SEP IRA, you can only contribute up to 25% of your earned income. Maximum is $61,000. There is no contribution, catch-up contribution on that one. And you can have employees with a SEP IRA, but if they are eligible for the benefits, that means they work over 1,000 hours a year, then you also have to match the contribution to their SEP IRA. So they would have to open a SEP IRA as well. So say you max it out at 25% of your earned income, contribute that full $61,000 and you have 2 employees, then 25% of their earned income also needs to be contributed to their plan, just cannot exceed the $61,000. The simple IRA is great for smaller businesses. You can contribute $14,000 with an additional $3,000 catch-up contribution if you're over the age of 50. If you do have employees in this plan, you can. You do have a 3% mandatory match. And then you have some additional plans that most people don't know can be self-directed. An education savings account, it's great for the kids and grandkids. It is a college savings account, and contributions can be made up until the age of 18. Now, $2,000 doesn't sound like a lot of money. However, you can partner that with some of your other IRAs or your employer plans on these investments, and that way that plan can grow along with the IRAs. And then you have your health savings account. Same thing. You could either be covered yourself or you could have a family plan. The reason I like the health savings account is that contribution that you make is tax deductible going in. And when you take it out for any medical expenses in the future, it comes out tax-free. So it's kind of like the best of both worlds, like a traditional IRA and a Roth IRA, but it's a health savings account and it's only meant for medical expenses, but it can be partnered just like that education savings account with these alternative type of investments. And if you're over the age of 55, there's an additional $1,000 catch-up contribution. So these are the most common types of assets that clients will make in their IRA. The investments we see are private entities. If you're investing in things like multifamily, syndication, startup companies, Reg A's, Reg D's, 506C's, 506B's, these fall under our private entities. So limited partnerships, any joint ventures, trusts. And then real estate's probably the next most common thing, whether it's a rental property, short-term rental, you're buying tax liens, anything like that would fall under real estate, where the IRA is listed on the deed as the owner of the property. Cryptocurrency, we're seeing clients, when they have that undirected cash, that's cash flow coming in, they might put it in crypto. I feel like crypto is very similar to the stock market. So really discuss that with your financial advisor and see if that's a good decision for you to make. Promissory notes, I like as well. It's pretty passive. With the rules that self-directed IRAs have, you want to look for those passive type of investments that we don't break those rules. We'll have to go over those in another class, but notes are great. They're either secured by real estate or they're unsecured. If they're unsecured, you can charge more interest. If they're secured, well, just like you go to a bank and you take a mortgage out, the bank lends you that money, but if you don't pay the bank back, what do? They foreclose on the property. So same thing with the IRA. You're like the bank, you're lending your money to whoever the borrower is. If that borrower isn't able to pay you back, you can foreclose on that property. And now your IRA owns that real estate. All right, so I'm real excited for my friend Rob Beardsley. He is the founder and principal for Lone Star Capital. If you haven't read his book, it's the definitive guide to underwriting multifamily acquisitions. He's a wealth of knowledge, speaks very high level. I'm real excited to bring him on. Hey, Rob, you there?
I'm here.
All right, brother, we are ready for you. Go ahead and share your screen, get started, and then I'll take over at the end for Q&A.
That sounds great. Thanks for the introduction, and thanks everyone for being here. I'm looking forward to giving my talk today about downside protection in uncertain times. And more specifically, this is going to be a discussion about sensitivity analyses and how the debt you use has a big impact on the risk of the deal. And I think that's pretty intuitive. We all know that leverage cuts both ways, right? When a deal is successful, the leverage acts as a magnifier for those returns, making them greater. However, when a deal is unsuccessful, leverage can act like a magnifier in that direction as well and make the returns worse. So leverage, in my opinion, debt specifically in real estate, is the greatest source of risk in a deal. And that's why we spend so much time focused on making sure that our debt is properly structured. And that's a dynamic thing because the markets are always changing, deals are always changing, and then the lending environment is changing. And so something I want to kind of first touch on is the way that the environment has changed. And so specifically, I'm talking from my personal experience in the multifamily world. So before I jump in, I'll just give a quick background on myself so that you get more context. I am the founder of Lone Star Capital. We're a multifamily owner-operator focused on Texas workforce housing. In the last 4 years, we've acquired over $300 million in assets. And we also are vertically integrated, which means that we have our own property management business integrated into the company that is based in Texas, which operates the entire portfolio. We raise capital on the equity side through a diverse range of investors, ranging from individual retail investors, high net worth investors, all the way to family offices, private equity funds, and so on. And we also do have, retirement account investors, IRAs, and whatnot. So, yeah, that's a great source of capital for us as well. And then on the debt side, we have a history of using agency financing, which is Fannie Mae and Freddie Mac debt, which is specific to multifamily. We've also used bank debt as well as bridge lenders. So those are kind of the menu of options on the debt side, and the debt world, as I mentioned, is always changing, and the most recent change has been quite dramatic and has affected people's businesses a lot. So rewinding 6 months ago, debt was very available and very cheap, and lenders were not too scrutinous of your business model, right? They would kind of believe in your projections and be willing to make a loan based on those projections at a high leverage point. Let's say high leverage is 80%. So we and many other investors were buying property at 80% leverage 6 months ago because, as I said, the lenders were making that widely available and it wasn't expensive. Basically, the cost, which is the interest rate, was very comparable to whether you took 80% leverage or 70% leverage. The difference in price was minimal. So therefore, logically, it would make sense to take on the extra debt because it would magnify your projected returns. But of course, it also adds to the risk of the deal. And that's something that we're going to focus on today, which is a difficult concept because quantifying risk is very difficult. If I put two deals in front of you and I say, well, deal number one has a 14% return projected, and deal number two has an 18% return projected, you may jump to the conclusion that deal number two with the higher projected return is the better deal. But if I tell you, well, deal number two is actually pretty risky, deal number one is safer, then maybe the decision is harder to make, and maybe you pick deal number one for the lower risk, but you don't know how much riskier deal number two is, right? So we need to know and have ways to quantify risk and understand risk better, so that way we can make these decisions. So fast forward to today, from 6 months ago, debt has changed dramatically. The cost of 80% leverage is tremendously higher than 70% leverage, and 70% leverage is higher than 60% leverage. So the pricing curve has really steepened to where every additional loan dollar you take in today's environment is more expensive. And that would be one reason alone to shy away from higher leverage, right, due to the added cost. But the other reason is the risk factor. If you believe that today we have uncertain times from a fundamentals perspective, and what I mean by that is, at the moment, performance is very strong, rent growth is strong, occupancies are high, collections are reasonably strong. So fundamentals are solid. But if we head into a recession, which some people argue that we're in one currently, then those fundamentals could deteriorate. Rent growth could slow, occupancies could go down, and collections could go down, and that would hurt your net operating income of the property, which could make making the debt service payments more difficult. And of course, the more debt you have and the higher the interest rate, the higher that debt service burden is relative to your income. So that creates more risk. So aside from the higher interest rate of higher leverage, just the higher leverage itself creates that additional risk of being able to make your debt service payments, which is extremely important. Obviously, we need to be able to have positive cash flow in order to be able to service our debt and stay in the deal for the long term if needed, right? If we have to ride out a storm, we need to rely on cash flow to be able to do that. And that's why deals without cash flow are so much riskier than deals that are without cash flow, because there's only a certain amount of time that you can keep going in the deal and servicing the debt before you run out of reserves or capital calls and no longer can make those debt service payments. But aside from the risk of debt service payments, there's also arguably an even larger risk associated with debt, and that is the maturity risk. And what that means is, when the loan is due, you have to pay back the loan. And that is your balloon payment, or that's your maturity risk. And the more debt you take on, the higher your maturity risk is, because that is a larger amount that you're going to need to pay back, right? If I have a $20 million property and I only borrow $10 million against that property, well, paying back that 10 million is going to be a lot easier than if I were to borrow $18 million against my $20 million asset. Because if my $20 million asset goes down in value by 15%, well, already I've lost so much value that I'm no longer able to even sell the property and pay off the debt. So it's very important to understand where your deal and its debt stands relative to its maturity risk. So hopefully that's making some sense and this isn't too boring. I know you're just staring at this spreadsheet and I haven't really introduced it. So I'll do so now. This is our underwriting model that I actually, years ago I built from scratch and have been iterating over hundreds of hours of editing and just putting well over 1,000 deals through this analysis. And so this particular analysis is for a property called Madison at Bear Creek, which is a property we're actually currently working on. And one of the newest deals in our pipeline and something that we plan on closing in September. So it's very topical, pertinent, and reflecting of the current environment which I'm talking about. So some things to point out on the debt side, because again, we're focusing on the debt today, is the loan to cost. And so for those that aren't familiar, you're likely familiar with loan to value, which is simply the loan amount relative to the purchase price. But loan to cost is a more sophisticated calculation and really a more true and accurate calculation, because it takes your loan amount and it divides it by the purchase price plus the capital expenditures, which is your renovation budget, with the idea being that your renovation budget is going to add value to the property, right? Typically the goal, let's say, for example, if you're going to spend $1 on renovations, you would hope to add $1.50 in property value through your renovations. Otherwise, why would you go through the effort of renovating the asset? So that's the goal of this loan to cost calculation, is that you are getting more value out of the asset through your renovation. So you can count it into your loan to value. So you can see in this particular deal, the loan to value is actually 73%, which is higher, but in reality, the risk of this deal is lower because of the loan to cost and the renovations that we have budgeted. Furthermore, the debt of 15.2 million in this scenario is not funded all up front. The way that this loan is actually structured is the lender is going to hold back the renovation budget. So actually, we aren't taking on the full debt amount up front, which is great for us because that's reducing the amount of interest that we're paying while we're not using those renovation funds. But then as we complete work, we will then show proof of the completion to the lender, and the lender will be able to draw those funds down from the lender, and that will add to the loan balance, which will increase our interest expense because we're increasing the loan balance. However, at that point in time, through our innovations, we should be not only adding value to the property, but we should be increasing the net operating income, which should make servicing the debt easier. So that's why loan to cost is a more sophisticated calculation and more helpful in understanding the true leverage and true risk of the opportunity. And just as I've been pointing out, go back 4-6 months ago, it was much more normal to borrow 80% leverage rather than being in the mid 60s. And obviously the risk parameters are very different for those different leverage points. But of course, the downside of that is you get less of a leverage or magnification benefit on your projected returns through the debt. Because of course, if we were to add more debt to this project, the returns would be projected to be higher. So we're always trying to balance having attractive returns for us and our investors, but managing risk. And so in today's market, we feel it's more prudent to focus on lower leverage and manage risk than it is to maximize potential returns, because it may cause us to have headaches in our portfolio in the future. And then the other downside of having lower leverage is the amount of equity that we have to raise for the project. As you can see, this is a less than $21 million purchase price. We do have a fairly substantial budget, a renovation budget over $3 million, and we're raising almost $11 million for this project. So we're almost raising double the amount of equity than we used to for a project of this size because of the lower loan amount. So that is a substantial equity cushion that provides a lot of downside protection. I'm going to skip over to the inputs tab here and show you a few more key points about this debt. So you can see this is a floating rate loan indexed off of SOFR, which is the most common short-term floating rate index, and with a spread of 2.75. And SOFR is around 2.25 today. So with the loan spread of 2.75%, that means today's pay rate on this loan is about 5%. And then, of course, SOFR is subject to change every month, and that can increase our interest rate on the loan or decrease it as SOFR goes up and down. And then finally, we have 2 years of interest only on the loan. So that means the first 2 years, we're only paying interest, and then every year thereafter, all the way through the 7-year term of the loan, it's amortizing. And amortizing payments do a few things. Number one, what it literally means is you're paying down the principal loan balance. So every month you're paying a portion of the loan back, which is reducing the total amount of debt outstanding, which further reduces your risk. However, of course, by not only paying interest and principal, now you are increasing your debt service burden, which makes cash flows harder, right? And obviously our goal is to maximize free cash flow that we can distribute to our investors. So amortization cuts both ways, similar to leverage. And we can, something interesting to point out, you can see in year 3, the cash flows are projected to average 5.5%, even though amortization kicks in that year. So it's really nice to see that even though amortization kicks in that year, because of our value add plan, and we're projecting to raise rents and improve our net operating income, we're able to still grow cash flows year over year in spite of the amortization. So that's really positive to see meaningful cash flows in an amortizing debt service. So I'm going to jump now to the sensitivities tab. But before I actually cover some of the sensitivities here, I want to touch on something I briefly mentioned, which is the fact that this loan that we're talking about today actually has a 7-year term. And that's fairly unique because most loans in today's environment are more short-term. I'd say most loans today have a 3+1+1 term structure, which means the initial loan term is 3 years, and then the lender offers 2 one-year extension options for a total of 5 years. However, those one-year extension options usually aren't that favorable. There may be a small to large extension fee associated with each extension, and there may be requirements associated with even getting the extension approved. You may want to get that additional year on the term, and you may be willing to pay the extension fee. But if your property doesn't pass certain metrics or underwriting requirements, the lender may opt to not allow that extension. And so now you're kind of stuck at the end of your 3-year term, needing to refinance your debt or sell so that way you can pay off the mortgage. And those are situations that we want to avoid. And that's precisely what we discussed earlier, which is maturity risk. So what you have here in front of you now is a few tables here with our refinance exit test, which really stresses maturity risk and what happens when the loan is due. So to recap, with a loan of 7 years of term that we have here, it reduces your maturity risk. But if we have a loan that is shorter in maturity, let's say only 3 years, that's going to increase our risk. And one of the reasons why is because if I only have 3 years to implement my business plan and have the positive benefits of rent growth, increasing my NOI year over year, that's pushed into a tighter time frame, and that's not going to allow me to maximize my value. But if I have a 7-year term or a 10-year term, that's more years that I have to enjoy rent growth and increase NOI appreciation. And so that way the property is likely to be worth more in 7 years than it is in 2 or 3 years. So something I'll show you here is, let's say we changed this. Well, let me explain first what you're seeing here. So the current scenario is where the loan is at this point in time. So what I want to do is, let's start with 36 months. And so we'll say in 36 months time, the NOI is projected to be at 1.7 million. And based on a cap rate of, I think we've got 5.25 here, that's a property value of almost 34 million. And I know I'm throwing a lot of assumptions here and everything, but bear with me. And feel free to ask questions. I'm not sure if we have that setting, but it looks like the chat's open. So feel free to ask questions in the chat, and I'm happy to make this interactive. But with a loan, with a property value of 34 million and the in-place loan in 36 months time of 15 million, right? That's a little bit less than the going in loan amount of 15.2. And that's because of that year of amortization here in year 3, right? So it gets it down to 15 million, which is great. You can see the loan to value is very low at 45% here. So we're in a very healthy situation here in 3 years, making it so that if we needed to or wanted to refinance and pay off the mortgage, it would be very easy to, because the likelihood of us being able to find a lender that could give us 45% LTV or $15 million is very high. We probably could get more. We probably could get 60, probably could get 65, or even 70, 75. And that makes the refinance risk very low, or the maturity risk quite low. So you can see in a base case scenario where we would be able to, in a healthy environment, get 75% loan to value, our new loan would actually be $25 million. So not only would we have the money on the new loan to pay off the old $15 million loan, we'd actually have another extra $10 million to pay back to the partnership. So that's cash out refinance proceeds that goes back to us and our investors. And that puts us in a really good position where we only have a little bit of equity remaining in the deal, and the cash flows are going to be very strong based on the residual equity still in the deal. One thing that you see here, though, this red, is this 75% LTV loan of 25 million actually puts the DSCR at a 1.16x. And so without getting too complicated here, this means that the NOI relative to the debt service or the interest on this loan is a tight ratio. And it's usually that's too tight for comfort. Lenders usually want a 1.2 DSCR or a 1.25 DSCR. So this loan is actually not that likely to be possible. So we might want to dial it back and assume only 70%. So now you can see we're at 125, and that's right where we need to be for the lender. But you see, by reducing it from 75 to 70, now the projected refi loan amount is 23.7. Still plenty of room to pay off the existing mortgage. So as far as risk goes here, we're very well protected in a base case scenario. But obviously, we're talking about downside protection in uncertain times. So let's go through some downside scenarios and some shocks that we call them here. So the first one is an operational shock. So what this means is your fundamentals are shocked. And that's something I described earlier, which is you have rent growth can slow, you have occupancy can dip, collections can dip, and that can result in a decrease in your NOI. So you can see the base case has a $1.7 million NOI, and the operational shock has a $1.4 million NOI. So this is showing here an 18% decline in NOI, which is pretty significant. And then based on this lower NOI amount, the property's value now is only 27.7 million, not the 34. And what does that mean? That means at 70% LTV, the loan amount that we can get is lower. So still at 19.4 million new loan amount in the operational shock scenario, it's plenty of loan proceeds to pay off the existing mortgage. So in a downside scenario with an operational shock, we're still very well protected. And yeah, we're in great shape. And you can see at this lower NOI amount matched with this lower loan amount, we're again at a 1.25 DSCR. So our DSCR is great. Our LTV is great. We're still in good shape in this operational shock scenario. So now let's look at the capital market shock and walk through this. So in the capital markets shock scenario, what we're assuming is that NOI remains the same. No fundamental changes. Rent growth is still strong. Collections are strong. Occupancy is strong. So NOI is the same. However, the capital markets have deteriorated. And what are the capital markets? They're essentially the lenders in the market and the value, the buyers and sellers in the market, which determine price. So the way that we shock the capital markets are we say that interest rates go up by 25%. And you know what I should do here, actually, and we can tinker with this, and I'm doing this on the fly if you can't tell, is, in today's environment, a 5% interest rate doesn't really seem like a shock now, does it? So I need to change probably as the base case being 5%. Now, this is for a permanent loan. So you can't compare quite apples to apples from a bridge loan to a permanent loan and so on. But if I change the base case of 5%, what actually is going to happen is our DSCRs are going to go down. So this is actually quite interesting. I should go back now and change the LTV to 60%, for example. And let's see here. So that was a bit too much. Probably 65 will get it done. So if we do 65, it's a bit tight, but we'll leave it at 65. So going back to the base case, again, plenty of loan proceeds. The DSCR is a bit tight. Operational shock, same scenario, right? We're taking on less loan proceeds because the NOI is lower. But now in the capital markets situation, the NOI is the same, but the property value is lower because we're assuming cap rates have increased. So increased by 15% from 5.25 to 5.75, which is a pretty meaningful move. Furthermore, we're going to also assume that in a capital market shock, the environment is uncertain and lenders are less willing to loan as they were before. So instead of making a loan at 65% leverage in our base case, they're going to loan only 60. And that is going to result in a new loan amount of 17.6 million. So worse than the operational shock, certainly worse than the base case, but still enough loan dollars to pay off the existing loan amount and have enough money to actually return some back to the partnership. And we can look at our DSCR. It's quite healthy here. So what that tells me is, in reality, even in a shocked environment, lenders would still probably be willing to make a slightly higher loan than this, maybe 62% or something like that. Now, finally, we get to the most exciting shock of all is when you implement both scenarios into one test. So what that means is we have the operational shock where the NOI goes down by 18%. At the same time, cap rates go up, right? So this is kind of like a classic recession where the fundamentals deteriorate, buyers are nervous, pricing goes down, lenders are nervous, interest rates go up. So what you now have is based on this new NOI and this higher cap rate environment, you have a $24 million property value. And at a 62% loan to value, the new loan amount that you could get is actually just under 15 million, and it's just under the current loan amount at this time. So what this puts us in a position, it's very tight. And this means that we technically fail this refinance test. And in a real life scenario, you would have to essentially make a capital call and add in equity. This would be a cash in refinance rather than a much more happy situation, a cash out refinance. So this is the risk that we're precisely trying to avoid. And even the bigger issue that we're trying to avoid is getting caught in this scenario and being forced to sell. When you're a forced seller, that's when you're selling, not necessarily at a loss, but you're selling at an inopportune time, and you do not want to do that. You want to live to fight another day. So if you have to do something between a sale and a refi in a downside scenario, you absolutely want to refi because it keeps you in the game, right? Price is permanent, financing is temporary. So that's why we're stressing this so much. So, however, so basically we're here and we failed in this both scenarios. So how do we pass this scenario? Well, by having more term, right? If we don't have to pay off the loan in 36 months, if we have, let's say, 5 years, so we have 60 months, all of a sudden things get much better. The property's value is up because we've had more time to grow our NOI, we've had more time for appreciation. And now our new loan amount, even in this both scenario, is 15.8 million, which now is plenty to pay off the existing loan. So now we have passed the refi test and we're in really good shape here. Very conservative in my opinion. The vast majority of deals, almost very few deals pass this both test. That's just the risk that we take in real estate, right? You can't make returns without taking risk. So there's no return without risk. So I don't think it's a bad deal necessarily if it doesn't pass this test, but it's just interesting to analyze and see where the risk is and how comfortable you are with the risk, and then you can decide whether the projected returns match the risk for you in your appetite and your investment goals. So here are just kind of some of the highlights and the ideas to tinker with, right? The more term you have, right, whether it's 36 months versus 120 months, makes it easier to pass this test, reduces the risk in the deal. Maybe another way to look at this also is how stable of an environment are you in and how strong of a market are you in? If you're in a stronger market, maybe the likelihood of an operational shock is lower. Similarly, if you're in a top market that lenders love, investors love, even if there's a downside scenario, there's still so much demand from the capital markets, from buyers and lenders, that your interest rates aren't going to go up quite as much and your cap rates aren't going to expand quite as much, which also puts you in a stronger situation in a downside scenario, specifically in a capital markets shock. And then finally, another way to look at this is simply the lower your in-place loan is, the easier it is to pass all of these tests, right? If I were to go in with, instead of a $15.2 million loan, but now instead an $18.2 million loan, all these tests are going to be a lot harder to pass. If I go to 36 months, I'm failing many of these tests. If I, for whatever reason, go to 24 months, I fail all of them. So that's another way to look at risk, and a way to moderate risk is by moderating your going in leverage. So that pretty much wraps it up for me today. I'm happy to take some questions and maybe go into some new topics if there's any recommendations.
All right. So we're live on Facebook as well, Rob. A few questions. So say somebody was investing into a syndication, can they ask for this, or is it offered to them to look at this type of underwriting?
Yeah, good question. So everyone's underwriting model is different, and I would say most sponsors are willing to share this information. That what we're looking at right here is shared with all of our investors. So it's not something that I think should be private, but not everyone has these types of analyses, right? Maybe their analyses look a little bit different, but by and large, I would say that if investors ask, something like this can and should be shared. And if there's a problem with it, I would be a bit worried why.
Yeah. Oh, this is really good stuff for due diligence. So, anyone listening and, you want to invest in things that are like multifamily, self-storage, a lot of time there is an underwriting sheet. And if you can understand it, that's going to make you a better investor. Sometimes people pay lots of dollars to have an attorney consult with them and break this down, but, you can always just ask someone to break it down for you. Rob, you did a great job explaining this and some different strategies that you're using.
Yeah, thank you very much.
Yeah. So any advice for any future investors that, want to make these types of investments? Like, what questions should they be asking?
Well, I think there's definitely staying on this topic, I think asking more information about the debt and asking about what leverage the debt is and what the debt metrics look like as far as loan to cost, loan to value, and the debt service coverage ratio, which we just barely touched on. We didn't even scratch the surface on debt service coverage ratio because today we were stressing maturity risk rather than stressing being able to actually service the debt. But debt service ratio, debt yield, and the loan to value, loan to cost are all really good metrics to ask for and to kind of have a gauge on the risk.
Gotcha. Okay. Did you say that debt with cash flow is riskier or not riskier?
Less risky.
Less risky. Okay. That was one of the questions here. Yeah. Anyone listening, go ahead and type those questions in the Q&A, and I'm happy to read those off for you. A few questions of my own, like you said, as long as it's in like a decent market, like I live in Orlando, Florida, this is a pretty booming market when it comes to renters, a lot of colleges here. It's not as risky, obviously, because there's going to be a lot of renters. Now we're seeing the prices of rents really dramatically increase right now compared to when I was in college. So I would think that somebody making an investment like that, it could sound like it would be safer if it's in the right market then.
Yeah, every market's different. And I think obviously we want to be investing in growth markets. Orlando would certainly be a growth market. But if you could also look at it from a downside perspective and say, well, is the employment base diversified, or is my property right near a school and all my tenants are going to school? Because what if a COVID situation happens again and a lot of students leave campus and go home or something like that? So not saying that those things are going to happen again, and I'm not saying that Orlando isn't a diversified employment market, but those are the things that you want to evaluate as far as downsides and being able to hold up through a difficult time.
Yeah, I mean, everything's unpredictable nowadays. We've seen what happened, and actually, I think it's better for renters right now with the fact that people can work remote. People are spending a lot more time in their homes, and I've seen a lot of people leave companies because they're looking for more of the remote type of work. And a lot of my friends and family live in apartments when they first move here, and it's a very transient type city. People move in and out constantly, so I feel like it's a pretty good market. What other things do you look for in markets?
Well, we like to stick to our markets that we know, and we like to really drill into the micro. But obviously, we want to see population growth better than the national average. We want to see a lot of product that we are interested in, right? We don't want to be competing for a very set amount of deals. We want to be in a market that's big and where there's a lot of deals that fit our criteria, so that way we can have lots of deals to analyze and sift through and then pick the very best.
Okay. So our listeners, obviously, they're IRA, they use their self-directed IRAs, they're IRA investors. If you are using less debt, then that would help them when it comes to UDFI tax, correct?
Correct.
Hey, that's something that when you're looking at deals, everyone listening, that's something you want to consider. Ask those questions and find out, because UDFI tax, the only way it's exempt is in a solo 401k plan. If you're using an IRA, you're going to be subject to that, and you're really paying taxes on the leveraged portion of your profits. So you're really making money off the borrowed money, but it's still taxed. That's what people don't understand with the UDFI tax. So it's just a good best practice to start asking those types of questions. Do you predict, the interest rates increasing higher than they already are now?
Yeah, so there's two main interest rates when we're talking rates. There's the short-term rates and then there's long-term rates. And more specifically, short-term rates, really talking about SOFR. And that's what, when we're borrowing a floating rate loan, our loan is based on SOFR and adjusts every month based on where SOFR is at. And then on the long-term rate side, we're specifically talking about the 10-year US Treasury yield. And that's how long-term debt is priced.
Gotcha.
And for me, I think it's much easier to predict where short-term rates are headed. There's a lot of guidance about it. The Fed is guiding the market as to where they want to take short-term rates. And so essentially the market is predicting that rates go up a little bit more from where they are now. And then sometime next year, they'll start to ease and come down. So I think we're going to, roughly speaking, be hovering around where we are now and maybe a bit higher for the next couple of years as far as short-term rates. Now, on the long-term rate side, the 10-year US Treasury yield is a very complex number, because it's, trillions of dollars are betting on it all day long. And it's dictated by inflation expectations, global capital flows, and growth expectations. And I think, based on all those things, I think inflation is going to slow down eventually again. I think also growth, I think, in the US is going to slow down a little bit. And the US will remain a global safe haven for capital, which drives down the yield. So I think long-term rates are going to be where they are today. I think I mean, certainly there could be volatility, but I think where they are today is pretty fair, which is in like the mid high twos. I think we'll probably stay around the high twos for the foreseeable future. Obviously we could go up and down, but I think that's kind of the rough range.
Yeah. Okay. Cool. Yeah, good information. So we're going to wrap it up. I don't see any more questions coming in. Rob, I appreciate you taking the time to spend, with our clients and our investors that are listening. We will post this to social media. Anybody listening, if anybody wants to reach out to you, what's the best way to reach you, Rob?
Yeah, the best way to learn more about us and reach out is on our website. It's lscre.com. I'll just put it in the chat. On our website, you can find plenty of good resources, such as our free underwriting model downloads. You can download the spreadsheet tool that we are playing with today. You can also get our free passive investor guide, and also fill out a investor form to get in touch with us directly.
All right, awesome. So check out the chat. That's how you can get in touch with Rob, speak with him one-on-one. If you had any additional questions or interested in any multifamily syndications that he's working on. If you want to stay up to date with NuView, you have questions about opening a self-directed IRA, you can reach us at IRA specialists at NuViewTrust.com. If you scan this QR code, you can follow us on social media, our YouTube page, Facebook. We post all of our content there, lots of videos and a lot of education on self-directed IRAs and different types of asset classes. Thank you everyone for joining us. Remember, our promotion ends August the 15th. The promo code is AUG22. That'll save you $50 on your application fee. And you can also scan that QR code to access the application. All right, Rob, I appreciate your time. Have a wonderful rest of your day, everyone. We will catch you next Wednesday at 1 p.m.
Thank you very much.